The upcoming recession, if any, has been the most widely predicted recession in the history of civilization, of course. Therefore, both markets and economic actors have front run it, which by definition reduces the probability of it happening and its magnitude if it does. I guess you could say economists and analysts lowered their forecast in response, leading to one of the most important drivers of equity performance this year, economic activity consistently surprising to the upside. Mark, what do you say?
I think one of the things that is worth considering is part of behavioral finance, behavioral economics, is a thing we call recency bias. So I think at the end of last year, it's been a terrible year for most people in markets. It'd be great if you were a macro trader and you were short everything except the dollar. Everything got down except the dollar. Everybody in the 60-40 world, the sort of long-term investor, they'd lost in bonds, they'd lost in equities, and they're feeling really rough. And they almost invented a recession as a reason to justify where they were. Now, 6 months later, you've had a bounce back in markets, and actually everybody's now positive. And I don't really buy into either side of it. So I think this really is a time to get back to the old style of investing, which is equities do their job, which is to deliver real returns. Bonds do their job, which is to deliver income. And cash does its job, which is to act as a way of risk managing. We've had a whole decade where it was all upside down. But I think now we need to think about how we're going to invest and manage for this new normal. And I think one of the things going forward is we need actually to recognize that the alternatives in your portfolio should actually be quite a small part of your portfolio. They've come to dominate so many people's portfolios. And one of the things that you have is if you're going to generate a return on your investments, you basically need to take a risk. What we've been doing is pretending that you can get returns without taking any risk. And all you're doing is saying you just don't realize what risk you're actually taking. And for a decade, or as you said, maybe 2 decades, what we've had is people have created these things, particularly to do with private equity, private credit, leveraged loans, property, all of which are said to be alternatives and offering a much better return than boring old equities or bonds or fixed income. And yet, at the heart of them, they've all got illiquidity and leverage as the source of their returns. Now, it's perfectly fine to accept that that's the source of return. But if you don't realize that, you then need to think we're going into a world where cheap leverage has gone away and illiquidity is now a big constraint. So one of the things that I'm telling people is that when you get a liquidity event, when you finally sell that property, or when you finally get out of that 7-year lockup private equity or private credit structure, be careful about jumping back into illiquidity, because this is not the same world that people were in. And actually, I think that is one of the things that we need to watch out for. Ironically, less in the US than elsewhere, which is that we've ratcheted up interest rates very, very quickly in a world where people are taking on an awful lot of debt, particularly housing debt, but also corporates are taking on a lot of floating rate debt. But if you have a short-term fix, they put up interest rates, nothing happens. So they put up interest rates, nothing happens. And then when your short-term fix rolls off, as is happening across a lot of countries and a lot of mortgage markets, and it's happening with corporates, suddenly you get a huge sticker shock. Suddenly your cost of funding has doubled or trebled. And that is the kind of wave that's yet to hit us, is the sense that people have been just watching the sort of short-term data without realizing what's been building up in the background. So yeah, I think we have to be a bit wary of saying, here's the monthly print on this or the monthly print on that. That's the world of the short-term leverage trader. Understand, for them, it's just a bit like sports betting. You know, they all put their bet on, it comes in a bit above or a bit below, and there's a lot of noise, and they move off again. If you're a long-term investor, we need to think a little bit more carefully about what are the lags involved in this. You know, should we really be expecting to see this yet? We shouldn't really. So don't be happy that they're putting pressure on to keep doubling up when we actually haven't seen the impact of the first move in either direction. Yeah, I think, again, one of the issues we've had in the first half of this year, as you know, is some sort of ridiculous number. I think it's approaching 80% of all the returns in the S&P 500 came from the 7 big tech stocks.
Yep.
Now, those 7 big tech stocks, they're like less than 10% of the economy, but they're a sort of, I don't know, a ridiculously large proportion of the S&P, almost like 40% of market cap or something crazy. So when you do the valuations on the S&P, you have, those guys are on 40, 50 times, whereas the other 493 stocks are on an average of about 15 times. Now, what I think is really, really super interesting about AI is this is going to do the same to services. Now, who do you think is going to get hit the most? Well, I think it's the people who've had the biggest price rises over the last 20 years. The people who've been least affected by the internet. And if you were to look at price increases or decreases over the last 20 years, decreases in goods, decreases obviously in TV and telecom equipment, etc., etc. The biggest increases in prices have been in medicine and education. And
Yes.
this is because there are bottlenecks, and there are bottlenecks in diagnostics. There are bottlenecks essentially in research. And so what would happen in education, both of these, incidentally, of course, during COVID, both of these kind of industries, if you like, both these professions told us that you could do everything online, which was a bit of a mistake from their point of view, because you look at education, you say, okay, well, teacher, you're saying that I can do everything online. I can watch YouTube lectures, but I don't have to watch your one. I can watch somebody else's who's much better qualified. And it's the same with the doctor. Effectively, you're saying that I don't need to visit my doctor. Okay, well, maybe I go to Amazon. I'll have effectively a diagnostic doctor. And then you scale it up a level and you say, who wins? Well, what I like to think of is we've moved from the jocks to the nerds, if you like, and now we're going to move to the empaths, because actually the winners, I think, are going to be the people who can work with the AI to provide the diagnostics and the service. And that means that the population as a whole will get a better quality education for a lower price and a better quality health for a lower price. And that isn't just in the West. This is a fantastic way of leveling up emerging markets up to developed market levels, because it has been the kind of the lack of the kind of professional who is essentially the gatekeeper to both of these services that has actually prevented its expansion. So if you now enable a diagnosis machine to diagnose 50 times as many processes, the individual then becomes so much more efficient and so many more people get their diagnosis. If you enable the teacher to effectively work with so many more individual pupils on an individual basis rather than in a sort of broadcast basis, then you get a better quality education. So I think it's fascinating. I think it's going to completely disrupt the service sector. I think it's actually going to be disinflationary.
Could I say liquidity is a snapshot while prices are forward-looking? Do you agree or disagree?
When liquidity disappears, you can get temporary mispricing in markets, because the price is not telling you what's expected to happen. It's telling you that somebody is a forced buyer or a distressed seller. So the market needs to clear. And so what liquidity can do, its absence can actually give misleading signals if we believe that the price is always giving us an indication of what the market expects to happen. It is, in a lack of liquidity, telling us that the market expects that that guy over there is going to have to sell out for a big discount because he is illiquid. So liquidity plays a very, very important role in markets, and its absence can mislead us. But yes, I mean, it helps market. It's required to help markets function, and it is why the Fed flooding the market with liquidity during 2021, while at the same time as the government was massively increasing fiscal spending. That's why we got inflation.
Do you think it still is going to be perhaps one more hike, a pause?
Yeah, well, I mean, as I say, I'm not a big fan of the models that led them to keep cutting interest rates because they thought they're going to stimulate inflation. And sadly, I don't think they had some sort of recognition that their models didn't work such that they now think that raising interest rates will stop inflation. Inflation, as I said, was really a function of that massive increase in the money supply. So the good thing is, for all of us around the world actually, is that the latest CPI print that came out last Friday at 3% surprised a lot of people. And all the noise traders, as I would call them, in the short-term rates markets and the FX markets and the commodity markets, all flip the narrative from rates need to go up a lot more for credibility and to get rid of inflation to, oh, they're going to pause now and maybe they'll come back down again. So why is that important? Well, I think what it means is that discount rates, it was the discount rate moving from it's going to be permanently too low to now it's going to be normal. That was the reason that equities went down last year and bonds readjusted. But this year, now we need to think about those less liquid markets, about property, about real estate generally, so homes, but also commercial real estate, but also private equity, private credit, and so on. People who actually need that short-term liquidity, because they've got two problems. At the moment, with cash yielding over 5%, it's crowding out markets that actually need liquidity. People are just holding it all, in money market funds, and it's not getting where it needs to clear markets. But the second thing is, we have this kind of weird thing where central bankers, like the Bank of England here in the UK, they claim that they're independent. They mean they're independent of the politicians, but actually they do exactly what the Fed does. So they're not independent at all. So the Fed has been setting global monetary policy. It's been setting it on bad models. It caused asset price bubbles around the world. It caused massive market distortions. It's now reversed tack because of the inflation, not because it's changed its models. The risk was that they would overdo it on the upside in the same way they overdid it on the downside. The positive, and to return to your earlier question, Angelo, we're a bit more positive, because actually I don't think they're going to mess it up this time, because actually, fortunately, the real world has come to the rescue and inflation is coming down, so they're not going to over tighten. And hopefully it means that the Australians, the Canadians, the UK, Spain, Italy, places where people have got a lot of debt on floating rate mortgages, who are getting crippled by this central bankers chasing each other up on whatever the Fed is doing, suddenly they're not going to have to find yet more money each month to meet their mortgage at the same time as the cost of everything else has been going up. So hopefully the Fed are going to pause. I don't think they should pivot. I don't think they need to cut, but they need to stop now.
You look at the yen. Do you look for opportunities in the Far East, investing in public companies? But how do I trust their accounting?
Equities are there to give you real income, real growth. So they'll give you a real return over and above inflation, because inflation is not going to be 0 to 2 anymore. It's going to be 2 to 4. So you need something that can protect you against that sort of return to a normal level of inflation. Fixed income, it can give you income. But again, to your point, where is the income coming from? So yes, you can get US treasuries, but what about some of the emerging market bonds? What about some of the overseas fixed income? I think that's one point at which you start to diversify on the dollar. Secondly, equities. Equities are there to deliver you real returns. Now, whatever anybody says, and I think we'll probably get onto China shortly, but everybody's saying how terrible China is. China is going to grow 5% real next year. Apparently that's terrible. The rest of the world is doing 1.5. Okay, so if you want exposure to real economic growth, look to China, look to Asia. I very much take your point about how do you trust accounting and so on. So then I would suggest something else maybe, which is the way I do things, which is essentially I don't buy single stocks. I buy into themes, I buy into factors, and I do it via smart beta ETFs, and I create a portfolio of the ones that I think are in the right place at the right time, whether it's exposure to robotics, or whether it's exposure to digital security, or whether it's exposure to clean energy or old energy or European bank, whatever these themes are that I have, I do it that way.
But in the next year to 5 years, will the BRICS being backed by commodities not only be a threat to the dollar, but will it be effectively, is the dollar become become less and less dominant.
That was talk about three-letter agencies, but one of the big ones has been the IMF. That came out of Bretton Woods, and the IMF has also caused an awful lot of disruption, shall we say, around the world with its policies. Its policies were, if you're going to have capital, you need to have it in dollars. If you have to have it in dollars, you have to do what the World Bank want, what the IMF want. You have to create an economy where we own the factories, you move your labor off the land and create cheap goods, which you then export to us. But you have to import the expensive stuff from us. And by the way, then Wall Street will come in and we'll do all this great stuff for you, like privatize all your public goods and then load them up with debt. And you'll have a fantastic booming economy until it crashes, and then we'll move on. So the IMF effectively has caused, its own amount of economic, shall we say, concerns over the last 70 years, 50 to 70 years. Now, the challenge to that is coming from the One Belt, One Road. So this is where it all ties in together, is that China has got a different way of doing things. It will build a railway because it wants to get the resources out of your country, but you end up with a railway. It's a different approach. And obviously that's a big source of power conflict, where the US is running around saying, these people are terrible, they're trying to get you into debt, et cetera, what like the IMF did for the last 50 years. And so this goes beyond just the dollar. It's part of a competing system.
What would it be? Would it be only gold that doesn't appear realistic per the gold reserves that we have or would buy? Would it be a combination of gold and silver? Would it be tied into agriculture? Could it be oil? Could it definitely try to be funny, although a little bit of truth to it, Bitcoin? Could it be a basket of several different things? And what could it or what should it be, Mark?
But in a sense, I think this is where we're going back to, where effectively China says, look, I'm going to buy that oil off you in RMB, or that coal off you in RMB, and you can buy stuff, you can buy electric cars off me or machine equipment off me or whatever. But if you end up with more RMB than you want, that's okay. You can swap them for gold. You can already do that on the Shanghai Gold Exchange. But you can swap, they've got, the Chinese have got about 1.3, 1.4 trillion dollars worth of gold, so they're fine. They've also got, of course, $3.5 trillion worth of dollars. So if you want dollars, you can have dollars. And you say, if you're actually backing it with existing assets, as opposed to, don't worry, we'll just print some more money and give you that, that definitely changes the kind of attractiveness of the exchange. So I think what's going to happen is, sadly, I think for you that they're not going to listen to your view, but actually, interestingly, that's pretty much what's already going on the other side of the equation. And so I think, and obviously, one of the other things that's been going on, and everybody is doing central bank digital currencies, which have their own issues, but everybody is doing them, whether they're admitting them or not. And so that just makes that whole accounting item thing even easier, because it's on the blockchain and everything just nets out. And you basically say, okay, where's your net account at the end of the day? Do you want to roll it in this notional currency, or do you want it converted into oil, or converted into gold, or converted into US dollars? So actually, these digital currency things, and Bitcoin, if you like, that whole technology just makes it even easier to move away from essentially the petrodollar system.
How do you think it will play out heading to the home stretch of this year in 2023?
I think one thing that sneaked through that people haven't really noticed is that the RMB has depreciated, not just against the dollar, but actually against a lot of its competitors. So I think the surprise may well be the flip. Everybody's got very, very negative on China. And I think one of the reasons is that's a narrative that has been created. So AI was a narrative that was created to justify buying the NASDAQ and shorting the S&P, when really you were just trying to cover your position. I think there's a lot of people selling China because they think they have to. And that's geopolitics and not to be ignored, and it's a major feature. However, in order to justify that, they've created a narrative that the Chinese economy is collapsing, and oh look, there's deflation over there, etc. I think that's misplaced, and I think we'll actually find some positive surprises coming out of China. And part of that may end up being negative surprises for the rest of the world. So, for example, China is now the biggest exporter of electric cars. Interesting narrative that the dominant political viewpoint in Europe is pretty much centre left, but the centre left view themselves as being in the centre. So, of course, anybody even slightly to the right of them, they regard to as being extreme right. So you'll have headlines about extreme right politicians, but actually they're not. They're maybe just barely centre right. Politicians will start to make a lot more noise in Europe. And I think there'll be a lot of challenge against the conventional wisdom on the war, on climate change, on policies around energy policies in particular, and the extent to which all of Europe is essentially doing the US's bidding on all sorts of issues to their detriment. So as again, one of the things, a lot of US corporates have done very, very well out of very successful and powerful lobbying, which has translated into almost a reverse takeover of Europe in the last 3 to 5 years. You look at, whether it's the drug companies during COVID, or whether it's the military industrial complex during the war, or whether it's the energy companies, from a bit of both. I think actually, I think we will find some political pushback against that starting to happen. We've already seen things start to happen in Holland, for instance, to some extent in Italy. Now people are talking about Germany and so on. So I think that's going to be a very interesting new aspect of the water warrior that markets will have to climb. So I think we might start off strong, but I then think we'll have a few hiccups along the way, as we always do, as we have to climb that proverbial wall of worry.
Where will the best opportunities from an investing perspective, where will the best opportunities arise globally?
I think the BRICS. I think this combination of BRI, Belt and Road Initiative, and BRICS, Brazil, Russia, India, China, South Africa, I think those two are delivering a very powerful economic impulse, and it will be BRICS companies and their bonds and their equities that will give you the best exposure to them.
If energy has been a victim of the tech rotation since January, how do you think commodities and associated material and energy stocks will behave in the back half of this year?
Well, again, that kind of slightly links into momentum. You have these momentum indices, which is quite important. So you can buy an ETF which tracks momentum index. Thing is that only rebalances once every 6 months. And if it does that, people have been front running it. So at the beginning of the year, those momentum indices, the ETFs full of momentum, stocks with good momentum, had loads of energy in. By March, it was clear they're going to be rebalanced to have loads of tech in. So people started selling energy and buying tech, which is one of the reasons we got that big impact into June and the rebalancing. Now, of course, it's going the other way around.
What do you make of the recent Biden-Modi charm offensive? Should we be getting long Indian equities?
Ultimately, Biden getting close to Modi is all about the geopolitics of trying to split India away from the BRICS. Will it succeed or not? I'm not sure. But that's not the real. I mean, India is developing, but at the moment, India is being held up as the anti-China. So, China's economy, the population shrinking, that's bad. When China's economy was growing, that was also bad. India's economy is growing, that's good. So everything that's bad about China is being said to be good about India. So you just have to see there's a lot of political narrative on top of this, and I would not want to chase the market that is already expensive, that actually has a history of disappointing at the stock level, that is actually really being pushed for a geopolitical narrative right now. So I wouldn't be chasing it.
Locations I gave you, how do you think globally assertive billionaires with long time horizons, how should they be looking?
I think 12, yeah, that's a very good question, and it wraps it up nicely. 12% cash is too high. It's fine for right now, but essentially Cash is going to revert to give you 0% in real terms as opposed to 0% in nominal terms. So you will still get a yield, but you will not beat inflation. And because it'll be designed that way. So you'll have reinvestment risk. The cash rates will come down. And so if cash is yielding you 3%, you wouldn't want 12% in your portfolio doing that. So that'd be the first point I would say. Secondly, I think that 26% in private equity is too high. And the reason I think for that is you're not getting, it's completely illiquid. The fees are very high. The long-term returns have come from a period of basically involving an awful lot of cheap leverage to deliver returns to the underlying private equity person. That is not a business model that is available any longer. So as your private equity rolls off, I would not go back to that level. So you can't sell it now anyway, but as you get liquidity events, you should not be rolling into more private equity. I think it's very, very difficult to make that case, I would say. Similarly with real estate, and certainly real estate, if it's yours and you own an office building, fine, but essentially to buy other people's office buildings right now doesn't seem a good idea. However, what you can maybe should do is there are some smart people out there who will have products that essentially are going in to buy that distressed real estate as it is distressed. So I think there's some opportunity there to buy into some SPVs or some hedge funds that are actually taking advantage of this new world. It's somebody that's trying to sell you the idea that the old new order is going to continue. You want to step away from that. Hence my point about private equity and to some extent private credit and real estate. I think you need more liquid markets. I think you need to be more global, less US. I think for your core, I think you have opportunistically, you should take advantage of people who actually, yes, they do charge you a fee, but they charge you a fee for their kind of expertise. And they don't necessarily tie you up for 7 years, which you really don't want to be close to zero.
Excellent points and a great way to wrap up. Mark, how could people learn more about your company? How could they reach out to you? Is there a website? Is there a Twitter, a newsletter? Please share.
Thank you. Yeah, there are three things really. I have a business called Market Thinking. So market-thinking.com is the blog that goes alongside that. I also have a Substack, which is marketthinker.substack.com, which shares most of the things with market thinking, but tends to have a little bit more on it. And then finally, I'm working with a company called Toscafund, who are a sort of well-established and well-renowned London-based alternative asset manager, who are really a family office. They think like a family office, they act like a family office, and they create products for ourselves, and we invite people like family offices to invest alongside us.